Well, it was another strong showing for U.S. stocks today. We closed near the highs of the session, and while the gains weren't quite as robust as yesterday, we did complete the best two-day rally that the U.S. market has seen since January. Now, despite that good news, there were still a few flies in the ointment. We did have oil prices fall dramatically yet again today, and the Russell 2000 small cap index was down slightly as well. So we'll see where this takes us. Of course, we've got the big jobs number coming up at the end of this week. In our trade application example tonight, I wanted to focus again on the consumer discretionary space, but unlike last night when I focused on a restaurant stock, tonight I want to focus on a theme park operator. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 5th, 2019. First off, if you are new, welcome aboard. Remember to go over to YouTube, click subscribe while you're over there. Also check out our description area if you want to sign up for our email distribution list. In addition to that, we're heavy users of Twitter. Make sure you're following me at Brandon Van Zee. And thank you so much for all of your likes and retweets for these Market Outlook related posts. Lastly, we do have a presence on Facebook as well. Feel free to join us in the group embedded in the logo in front of you. All right, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us. This will show us the four major U.S. equity indices, and it'll give us a heads up as far as what the posture is using the Market Forecast Technical Indicator. As a reminder, the Market Forecast Technical Indicator can be found on the Thinkorswim platform or other TD Ameritrade products that are out there. And that market forecast indicator is that indicator you see at the bottom of each of these four charts here. Now, we've used what's known as ThinkScript to help us identify posture changes by coloring the background colors of the charts either pink or green. And so as you can see right now with the S&P 500 and with the Dow Jones and the Russell 2000 and the NASDAQ, we continue to have that bearish posture from an intermediate perspective. So remember, what we're using for that is that green line down below in the market forecast tool. That's known as the intermediate term line. And when that line is below 20, we consider that to be bearish. So notice here on the S&P 500, the current reading of that intermediate line is 19.21 and rising. In other words, if we have one more up day tomorrow, there is a very high likelihood that we would switch back to a bullish posture tomorrow. But if we have a sell-off tomorrow, could prolong that potential change in posture. Remember, this rally, for all intents and purposes, is only 2 whole days long. Now, they've been pretty aggressive days, mind you. Again, as I noted in the intro, notice that we closed near the highs of the session today. But nonetheless, as much as this has felt like a little bit of a relief rally that we've experienced, we have to keep in mind that that downtrending 30-day moving average could still very well cause a little bit of heartburn for those of you that want to be bullish in these markets, because once the markets do fall below that 30-day moving average, oftentimes it can be used as resistance. You can see that happened right here on May 16th. We fell below that moving average, popped back up to it, basically kissed it, and then bounced back away from it. And now you'll notice that that moving average is slumping over at an even greater degree. That moving average color is red as opposed to yellow or green, and what that signifies is price is currently below a falling moving average. So while it's wonderful that we've gotten a nice kind of dead cat bounce out of those really oversold areas where we were getting those oversold cluster signals there a few days ago, I don't think it's quite to the point where we're out of the woods yet. So we have to do a little bit more work from a technical perspective. You'll notice here as well that the market sentiment lines are all falling as well. So notice that in the orange label here, you can see whether the lines are falling or rising. So the orange label there, right there, right there, and right there all say falling. And so that reminds us that from a longer term perspective, more than the intermediate term, which we kind of tend to think of as like 3 months if you wanted to put a time frame on it. So more than 3 months, the posture would remain a little bit bearish at this point as well. So again, a little bit of work to do, but Definitely don't want to dismiss the rally that we've had the last couple of days. It definitely has been substantial, and it's been nice to see cooler heads prevail as opposed to what we seem to have stumbled across in May, which was almost selling every single day, it felt like. Let's go ahead and take a look at our next chart setup now, and this will be chart 4C. This will be our 3 green arrows chart setup. As it stands right now, we do have a little bit of new information to share with you here. 3 out of our 4 charts did lose their 3 red arrows signals here today. That's a good thing for those of you that want to be bullish. The only one that remains with 3 red arrows is the NASDAQ. You'll notice down below here in the lower left-hand corner, we've got a red arrow there on the 30-day moving average. We've got a red arrow there on the MACD histogram, and our most recent arrow on the stochastics is a phantom red arrow right there. You'll notice that on our other charts, we start to get a little bit of green shoots popping up. We've got 2 green arrows here on the S&P 500 now, both stochastics and MACD histogram. Same thing goes for the Dow Jones. Green arrows on both of those indicators. And not quite as steady down below here with the Russell 2000 because we still have a red arrow on the stochastics, but we did get a green arrow there on the MACD. So for 3 out of these 4 charts, we've got mixed arrows. For 1 remaining chart, that's the NASDAQ composite, we do still have that more bearish tilt with the 3 red arrow signal. Moving right along now to our 1040 crossover method. As a reminder, these charts don't move quite as much, so we don't spend as much time reviewing these, but do want to point out, in case you've missed it here in the last few days, that the Russell 2000 does now have what's known as a death cross using the 10-week moving average, which is the orange line, and the 40-week moving average, which is the blue line. You can see that that cross occurred as of last Friday. So we're only 3 days into this death cross, which means, if we do get a positive market rally into the summer, we could quickly reverse that back to bullish. The other areas like the Dow Jones, the S&P 500, and the NASDAQ still have quite a bit of wiggle room there before the moving averages themselves will start crossing over. Moving right along now to our next chart setup. This will be chart 4E, and these will be our 12 grids here. So reminder, the 12 grids are a view of about 3 months worth of time. Each one of the candles that you see represents 1 day, and the background colors of the charts will tell you whether we have a bullish posture or a bearish posture using the market forecast intermediate term line. In other words, that green line on the market forecast indicator itself. Now, one quick reminder, if you ever wanted to see the market forecast indicator, all you have to do is right-click on one of the charts. So let's do that with, let's say, foreign bonds right here. I'm going to right-click on this chart. I'm going to go to Maximize Sell. And you'll notice down below that that market forecast now shows up, at least for those of you that are premium members of Market Scholars and have access to our charting program here. So right now, you can see that on this first set of 12 grids, which is our intermarket analysis, it's a bit of a mixed bag. We've got 1, 2, 3, 4, 5, 6 bullish charts, which means we also have 6 bearish charts. The bullish charts are from preferred stocks, which, let's be honest, it's more of a sideways trend there, so I don't know how excited I would be about that. But nonetheless, we do have a slight upward bias towards preferred stocks right now. Government bonds, now that has not been a news story. In fact, that has been par for the course for the better half of the last month. What is somewhat noteworthy is that we did see the second straight day to the downside on government bonds. So although we keep our bullish posture on TLT, notice that we had 2 straight red candles there, which is something that we hadn't seen since these 2 candles back here, May 20th and 21st. And you can see that the pullback has been a little bit sharper this time than what happened back then as well. Of course, in between those 2 moments, we had basically a straight shot higher. So probably a chance for government bonds to kind of cool off a little bit after being one of the hottest trades in the market. You'll also notice that foreign bonds have a bullish posture, and that has been just incredibly consistent. I mentioned this maybe a month or so ago as well, when it first started catching my eye that this thing was, handling the market chaos reasonably well. I would have never guessed that the consistency of the move higher would have shaken out the way that it ultimately did. I mean, if you look at these candles, it's like every single day they go up and up and up and up and up. Even today, when the U.S. government bonds fell, foreign bonds still found a way to make their way higher. So that has been really impressive. Another impressive area has been REITs. Every so often I kind of get that sense that maybe REITs are going to finally give up the ghost, and then all of a sudden they pull a rabbit out of their hat like they did today. Take a look at VNQ as just one example, up over 2%. REITs have been one of the hottest sectors on the market. In fact, one of the sectors that we've been concentrating on quite a bit here recently. My top-down trend trading class, the stock that we traded on Monday's class, was actually in the real estate space itself, one of the stronger ones within that area. And so for those of you that do concentrate on real estate investment trusts, you're probably cheering that on right there. And of course, REITs are oftentimes aided by interest rates that are falling. And that's what makes today even more peculiar in a way. Interest rates were up, not a lot, but they were up a little bit, 0.19%. You wouldn't have necessarily expected VNQ to be up over 2%. As you can see, that candle right there is one of the biggest ones on the entire board for the last 3 months, probably with the exception of that day right there on May 21st. So again, a bit peculiar there, but don't fight the trend. The trend is your friend, all that fun stuff. And of course, REITs have been one of the strongest trends out there here in recent weeks and months. As we look at a few of these other charts here, note that gold and ag commodities are also bullish, but both of them had a little bit of a kind of bearish end to the day. Note that gold did close higher today, so I don't want to throw it under the bus or anything like that, but you will notice that this candle that it has, let me right click and maximize that sell. Notice that is not the world's best looking candle right there. A lot of times if you want strength out of your securities, you want them closing near the highs of the day. Take a look at this really long upper shadow on this candlestick right here on gold. So it's basically telling you that while there was some enthusiasm for gold on an intraday basis, by the end of the day, the bears had kind of taken control and driven that stock price a little bit lower. You'll also notice that DBA was lower today, so despite having a bullish posture, it was down 1.38% today. And then crude oil, I mentioned this in the intro. Take a look at crude oil, down another 3.31% today, easily eclipsing new 3-month lows here. So despite getting some of those oversold cluster signals here recently, still not an opportunity for a reversion to the mean bounce quite yet. Things have really gotten quite ugly there with crude oil. Now, also note over here on the lower left-hand corner is the US dollar. The US dollar now has a bearish posture. It has had for the last day or so. But nonetheless, what I wanted to point out was the dollar actually had a pretty good day. It was up 0.34%, closed near the high of the session. So that should help explain why these other commodities look the way that they do. Remember, when the US dollar is strong, those commodities that are priced in dollars tend to be a little bit weaker. And so when we saw gold close near the lows of its session, and we saw ag commodities close near the lows of its session, and we saw crude oil down another 3% today, that could be largely due to the fact that the US dollar basically closed at its highs of the day right there. Also note the VIX is down to 16 again after having quite the robust move in early May. It's kind of left with a whimper here in the last couple of weeks. All right, let's go ahead and take a look at our next chart. And this one will be our foreign stock markets. This is chart 4F. All right, so as we pull this up here, it's a brighter picture. A lot more green charts popping up here. And so as we kind of review these, one of the things that does catch my eye right out of the gate, maybe it's just because it's the first chart on the board in the upper left, Brazil does have a bullish posture right now, and that's great. But that's a pretty ugly looking candle that you got there in Brazil today as well. So maybe be a little bit leery about that. We've had a really nice run out of those oversold conditions on EWZ for basically the last 2 weeks. Today was a pretty ugly reversal type of a candle where we had kind of a bearish engulfing type of a candle there. Maybe need to come back in and settle near that moving average before deciding whether it needs to make a bounce or not. Some of the other charts out there that have caught my eye recently, India has retained strength near 3-month highs, although that's probably not the best sign. That's been kind of lingering the last 3 days up in this area where it's found resistance on at least 3 different occasions here in the last 3 months. So, that does put a little bit of hesitation in the back of your mind if you're a trader, thinking, boy, we just had this really nice rally out of India. Looks like it's going to keep on running. We have this nice moving average that's turned green for us here recently as well, yet price action just kind of refuses to get beyond these key touch points here from basically March through mid-April. Also, Australia had a really nice day yesterday. Some of you might have seen the retweet that I had of Charlie's, where he was talking about Australia having cut its rates from a central bank perspective. That may have helped Australia have a really nice day yesterday, but it kind of gave back a decent chunk of that today. Now remember, yesterday included the gap up in addition to the body of the candle. Today, that looks like almost the equal size type of a candle, but it does not include any gapping with that. So it was only a 0.41% pullback on Australia, but still a little bit of a disappointment, a cold, wet blanket on that, because it looked yesterday like this thing really wanted to start firing to the upside. All right, let's go ahead and now take a look at our U.S. sectors. And this one will be chart 4G. All right, so as we pull this up here, things continue to brighten in the United States as well. Remember, it wasn't too long ago we had a clean sweep. All of the charts on this particular chart setup were red. So it's great to see now, all of a sudden, we actually have more green charts than red charts. So 2 days to the upside can do wonders, especially when they've been as strong as they have in the last couple of days. So again, the strength that we have seen in the markets has largely been kind of a defensive nature. You'll notice down below here, real estate. Take a look at that. That's XLRE. It's a slightly different look than VNQ that I showed you before. This one is the select sector spiders version of the real estate. So these ones are only going to be real estate stocks in the S&P 500 here when you're looking at XLRE. But take a look at that breakout right there. If I were to right click and maximize that cell, that's a nice looking candle. Right? That's a beautiful looking candle above a breakout zone. And of course, we experienced a really nice bounce off of a moving average here within the last week as well. So looks like we've got a continuation move here out of the real estate investment trust. So look for some opportunities there. In addition to REITs, we of course have utilities making a nice move here as well. So let's right click and maximize the sell there. This one's not quite as emphatic to the upside as real estate was, but nonetheless a very solid candle there, closing near the highs of the session. And we do have new intraday and closing 3-month highs here for utilities. In fact, that might very well be all-time highs with utilities. Let me just double check on that. Yeah, that's all-time highs, utilities right there. So utilities have been one of those safe havens to be looking for opportunities to the upside while there's been a lot of other chaos out there. Remember, utilities are largely a domestic sector. Very few utilities have operations outside of the United States. There's a handful of them, but not very many. The vast majority of utilities only do business in the United States. So all these, trade skirmishes, whether it's between China or Mexico or whoever else, a lot of that does not directly negatively affect utilities. It might indirectly affect them to a degree, but this is kind of perceived to be a safe haven, not only because of the lack of volatility, which, by the way, was one thing that we really hammered home on in my strategy lab swing trading class earlier today. One of the leading factors out there in this market right now is low volatility, and this should tell the story why. The market is preferring REITs and utilities right now, and those are oftentimes viewed as some of the least volatile investments in the marketplace. So utilities, REITs continue to be leadership groups at this particular juncture, and also would want to point out that both healthcare and staples down below here on that bottom rung, both of those are now trading above moving averages as well. Whereas the other charts, some of them are perking up. Notice here industrials and financials are perking up as well, but they're still trading below their falling moving averages. Materials has had a nice run in the last 3 days. So while the trend does not look nearly as strong as what we see down below here with real estate, at least it is also trading above its moving average. I don't know how long that can last. A lot of times when we have this kind of rapid rocket fire move to the upside, you usually have to kind of settle into that type of a move before you start seeing that shape of that moving average start to pull higher yet again. All right, real quick, wanted to say thank you to everybody that did click like on the market outlook video yesterday. I believe there were over 100 of you that did that, which is usually the goal or the bogey that I've set for myself. So thank you to those of you that do that on a regular basis. 104 of you did that. Remember, you can do that by going over to Twitter directly and looking at the pinned tweet at the top of either David or I's timeline. You can also just click like on Twitter right here on the Market Scholars website here while you're watching this video. We also have the link to Twitter in the emails that we send those of you that are on our email distribution list, and then we also have it embedded in our description area of the YouTube videos area itself. So a lot of different ways where you can do that, but again, that is kind of how we score ourselves and whether we are spending our time effectively or not. So if we can get 100 people regularly clicking like on this, then we can justify continuing to do them. So thank you for doing that for me this week. David will be with you tomorrow and on Friday, and I'd expect you to do the same thing for him as well. Thank you in advance for that. All right, let's go ahead and talk about our trade application example here for today. I mentioned in the intro that I wanted to stick with the consumer discretionary space. Now, last night, for those of you that watched the video, you recall that we talked about a restaurant stock, Jack in the Box, and recognized that nice breakout that we saw yesterday. Great continuation move out of Jack in the Box here today, 2.28% to the upside. I wanted to talk about a slightly different type of discretionary stock now, and it's a stock that kind of reminds me of summertime. Kids are out of school, time to go on vacation. Disney World, right? So Disney, you'll recall, is a trade that we actually did in my presentation here for the Market Outlook video a few months ago, and we got awfully lucky on it. Sometimes it's better to be lucky than good. And we did I believe it was a long call vertical spread on it, somewhere over in this time period. It might have been late March, early April, somewhere in that time period. Now, we knew that they were going to have an announcement coming up regarding their streaming service, and that was part of the impetus for us wanting to do that bullish trade. Now, admittedly, I never, ever expected this type of a gap up to occur. I was thrilled that it occurred. The only regret I had was that we didn't that we didn't do just long calls naked as opposed to a long call vertical, because we did somewhat limit our upside potential. But nonetheless, you're not going to look a gift horse in the face. So we were thankful for that big move higher. We have largely just consolidated that move since that time period. You'll notice it did kind of meander its way higher for the week or so after that, but you can see that Disney has largely been sideways here. Let's call it for the last month and a half or so. Now you'll notice things are starting to change here more recently. First of all, notice that a couple of days ago, Disney was up on a day the stock market was down. Remember, this was Monday right here. Disney was closed higher slightly on Monday, but still closed higher nonetheless. It rallied with the market yesterday, closing at the highs of the day yesterday. It rallied again with the market today, closing at the highs of the day today as well. So that's very promising price action right there. You'll notice that along the way when that occurred, we saw this green line, this intermediate line on the market forecast technical indicator, go from being in a downtrend here to now reverting back to the upside. So our hope is that we're going to start a renewed upside move out of Disney right there. You'll also notice, of course, the background color of the chart changed to light green to identify that for us, but also notice what else changed here was the moving average itself. That 30-day moving average is now colored green as opposed to yellow or red, and what that is signifying is price is above a rising moving average again. So that's a promising sign as well. You'll also note that here in the last month or so, there's been kind of three candles that stick out to the downside. This one, and this one. They all bottom in about the same area right there. So it does kind of give the impression that perhaps there is a big buyer waiting in the wings at around that level. So what I wanted to do here tonight was another one of these kind of one cancels other swing trading types of orders, similar to what I showed you last night with Jack in the Box. So this will be a straight stock trade. It will not include options. I actually did look at the options again on this one. I kind of wanted to do a sold put spread on this with the 130 put being the sold strike, but unfortunately I just couldn't get the strikes to work out. The monthly contracts didn't have dollars between the strikes. They were $5 wide, and then the weekly contracts just really weren't able to give me the return on risk that I wanted. So, perhaps for some of you that have different types of rules, you could look at that sold put spread. But for tonight's example here, I'm just going to do a regular stock trade here yet again. And what I'm going to do is I'm going to kind of focus on this candle right here and look at the low price to kind of establish where my stop loss will be on this trade. You'll notice up here above the chart there's an L colon. That stands for the low price of the candle that you're pointing at. So let me go back to point at that one. And you'll notice that the low price was 130.78. And so a lot of times I like to go a couple of pennies below that for my stop loss. So we'll put our stop loss on this at $130.76. That way, if we're proven wrong, it's got to come down and close below that most recent low there for us to lose on this particular trade setup. So if we were to get our calculator out and if we wanted to maintain kind of a 1-for-1 reward to risk ratio like we oftentimes do in my strategy lab class, I would take the current price where I expect to get filled, which is 135.94, so that's the closing price right here, and then we'd subtract out that stop loss area that I mentioned a moment ago, which was 130.76, and that means that we're taking on about $5.18 per share of risk. So if we took that same number to maintain that 1-for-1 reward risk ratio, we could take that same $5.18 and then add it back to the current price of 135.94. And you'll see that that means that our upside price target would be 141.12. Now notice 141.12 would be about, let's call it, somewhere in that general vicinity. So in other words, if you kind of want to visualize what you're hoping to accomplish with a trade like this paper money example, you're hoping the stock continues its upside momentum towards this prior high candle over here. It doesn't need to breach it on the upside. It just needs to get into that kind of upper half of that range. And on the other side of the coin, you do not want it to slip back into kind of more of a meandering or a falling type of a pattern, because if it does fall down below this candle here, you will be stopped out at a loss. All right, so in order to do that trade, let's just go ahead, right click on the chart. I'm going to go to Buy Custom with OCO Bracket right here. That loads up our trade down below. I'm going to clip that together. I'm just going to leave this at 100 shares by default since this is just a paper money account, and I'm just showing you an example here. Obviously, you're going to want a paper or position size, however is best fit for your own portfolio. All right, now I'm going to change a couple of things here along the way. I am going to change this second line, in other words, this line here in pink, the first line in pink or the second total line, I do need to change that from a date to a good till cancel order because that's going to be our upside price target. And for that, we were going to use 141.12. On that next line down where it says stop, I also want to change that to good till cancel. So that way our stop order is working on our behalf day after day after day. And then that final line item down there where it's asking us to place our manual stop, I'm going to type in 130.76 there for that. So again, hoping to buy it right around the price where it closed here tonight, and then hoping to sell it at 141.12. And if that doesn't occur, then we'll be stopped out at a loss down at 130.76. Confirm and send. Review that one last time. We'll send that in, and we'll hope everybody goes to visit the Star Wars themed areas of Disneyland and Disney World this summer to support our trade here tonight. All right, well, thank you for joining me here yet again today. Looks like we had a really strong rally for the last couple of days. We'll see if that can continue. As I mentioned before, we do have an important jobs number coming up on Friday, so be aware of that. Also, David should be back in the saddle with you tomorrow and on Friday, so look forward to his excellent analysis as always. And if you got value out of having this video tonight, make sure you do click like over on Twitter. We do appreciate that. Thank you so much. Have yourself a great rest of the day. Bye-bye.